As it stands here today, it appears we've hit a local bottom in Bitcoin down at the $75,000 range, and we've recovered from that, and now we're bumping up against some serious resistance at the $88,000-$90,000 level, and we've got to kind of break through that mentally and hold that for this to stand. But I think that Bitcoin's catching a wave like similar to gold, where you've got investors who are putting money in both gold and Bitcoin, and that the US dollar being weaker is making Bitcoin stronger as well. And so it's a long way of saying that the decoupling, I appreciate it. I like it. I want to see it continue. And we're going to have to see, weeks and months of this for it to really hold.
Bitcoin has surged past $90,000, but according to James Lavish, chartered financial analyst and managing partner at the Bitcoin Opportunity Fund, the real challenge now is whether it can maintain that momentum. After bouncing off strong support at $75,000, Bitcoin is now testing critical resistance in the $88,000 to $90,000 range. Lavish notes that while the rally is strong, holding above this zone is essential for the momentum to be sustained. What's driving the surge? A weaker US dollar, rising gold prices, and an increasing number of investors viewing Bitcoin as a safe haven alongside traditional asset. The early signs of Bitcoin decoupling from the old financial system are beginning to appear. However, Lavish emphasizes that in order for Bitcoin to truly establish itself as an independent asset class, this strength must be maintained not just for a few days, but for weeks and months to come.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
The divergence from Bitcoin and risk-on assets like the NASDAQ and regular stocks, at the same time that bond yields are going down, actually, I'm sorry, the bond yields are going up, so bonds are going down. So you would think that the flight of safety would be to bonds. And for people who are new to this whole game, when you buy bonds, you're buying them at above or below par, right? And if you buy it below par, that means you're buying it at a discount, which means that the interest rate you're effectively paid, because you're getting paid coupons on these things. Those coupons are set. So if you paid less for the bond, then that coupon becomes just a larger percentage. And so that's why yields go up when bonds go down. And that's kind of the way it works, right? So, but you would think stocks going down, well, then bond yields would probably be going down too, because bonds would be going up, because that money would be flowing into safety assets, like the risk-free asset, which is the US Treasury. Not really risk-free. We know that. We talk about that all the time, but that's the quote on Wall Street. Risk-free is the US Treasury. It's not. It's not risk-free. We learned that the hard way during the pandemic, when we way overprinted money. Not we, the central bank, the Fed, way overprinted money, caused massive inflation from the expansion of the money supply, massive asset inflation, massive inflation across financial assets. And because we're so financialized as a nation, everything went up in price, along with supply issues and supply chain issues and bottlenecks and all that. But that was kind of a goat that should have gone through the boa and gotten out the other side. It never did. And we had these this crazy inflation for years and years because of the expansion of the money supply. Let's just call it what it is. So you saw bond yields. What happened was bond yields spiked because Fed funds went up, and bond yields went up in order to compensate investors for that high inflation. So if you're a bond trader, you're not going to buy a 10-year treasury at 2% if inflation's at 5%. You want to be compensated for that. And so when that interest rate goes up, the bond price goes down, and all these banks, all these community banks that were holding these treasuries got absolutely annihilated. And that's ultimately what caused the collapse of Silicon Valley Bank 2 years ago. And that's kind of, if people remember back, well, that's not risk-free to me. That sounds risky to me. It's risk-free in the sense that yeah, if you hold it to maturity, it's a non-zero probability that the U.S. will hard default on that, but it's about as close to zero as you can think of, because the U.S. Treasury has the ability to team up with the Fed and print money to buy its own bonds. So of course they're not going to default. They're just going to print money and make sure that these things are always trading. And so, that's it's called the soft default. And that soft default is inflation through expansion of the money supply, which is debasing the U.S. currency every single day in order to keep this whole debt charade going. And that's kind of the point, right? Let's back it up and talk about big picture what's been happening. Well, Trump has threatened to enact to enforce these tariffs on all these countries, and big tariffs. And so that has caused quite a bit of angst for a number of reasons. There's angst with people who import materials and goods to sell here in the United States. So you getting some misinformation of the actual demand, the underlying demand of the economy, because you've got manufacturers and suppliers who are importing goods in order to get ahead of that tariff. The underlying economy has not been doing that great. There's a lot of negative indicators out there. And so we're just watching these things and seeing if they continue to kind of snowball, especially things like the unemployment rate, now that you've got government jobs coming out and all of that. But so you've got the economy is clearly softening. You've got cross current of information of what are the actual trade numbers, what are the actual purchasing and index and the PPI and all that. What's PMI, what are all these telling us? And then at the same time, you've got investors who are worried that the earnings of companies are going to get negatively impacted. At the same time, you've got bond investors worried that, well, if we're going to, hammer China with these huge tariffs, they're going to turn around and they're going to shore up their own currency. And they're gonna turn around, and the way they do that is by selling treasuries that they have. So if they sell U.S. treasuries, what does that make the treasury do? It goes down in price and yields go up. Something we may be seeing here, right? And so, or it could be traders getting ahead of that, worried about that scenario where China starts selling bonds, and not just China, other countries too, selling U.S. treasuries in order to get dollars to sell those dollars and buy their own currencies. Those are possibilities. You're seeing the dollar go down in value against other currencies across the board here. The DXY is down, and that suggests some of this is happening, or just the confidence in the U.S. dollar, the U.S. treasury is waning. That's all happening. And then you layer on top of it, Marty, that basis trade I was talking about. And that's kind of like the powder keg that is behind the scenes that the very, very intelligent investors know about. They understand it, and they're watching carefully. They're watching credit spreads. They're watching the spreads of the bonds to the futures, the bond futures, and they're gauging whether or not this trade has is going down the path of blowing up in hedge funds' faces. And there's a reason that this matters, and we have a history of this, right? So you are younger than me. You likely weren't paying much attention to this back in 1998, but I was a trader at a hedge fund, and we were doing all kinds of arbitrage strategies: convertible arbitrage, merger arbitrage, risk arbitrage, pairs trading between different companies. We had books and books and books, billions of dollars to work in these arbitrage trades. And there's a hedge fund, large hedge fund called Long-Term Capital Management.
Bitcoin is climbing while the traditional financial system continues to unravel. Stocks are bleeding, bond yields are rising, and even U.S. Treasuries, once considered the ultimate safe haven, are being dumped as investors scramble for protection from persistent inflation. The old playbook of selling stocks and running to bonds no longer works. Yields are rising because trust is eroding, and the so-called risk-free asset now looks more like a trap, burdened by decades of money printing and runaway debt. This is what decoupling looks like in its early stages. Bitcoin is beginning to break free from the gravitational pull of a system that's collapsing under its own weight. The Treasury market still clings to the belief that the US government will never default, but as inflation quietly eats away at the dollar, that belief becomes more fragile by the day. Unlike fiat, Bitcoin doesn't play by those rules. There are no bailouts, no endless printing, no dilution, just code, scarcity, and predictable supply. As the old order begins to crack, Bitcoin continues to rise, offering a glimpse of a financial future governed by math, not manipulation. Now, let's dive back into what James Lavish has to say.
Is there any feasible way to unwind that trade outside of overt intervention from the Fed?
Not rapidly, not quickly. You know, I mean, it could be catastrophic to the market. Yeah. So you've got it. I would imagine some of these, some of them are unwinding some of it, but I'd also imagine, Marty, that you've got hedge funds who are stepping into it, you know, like they're looking for opportunity. If they see an opportunity, they think that they can stomach, they're going to step into it. So it might just be moving from book to book. We don't know. It's hard to tell. And so much of it is on swap. It's hard to tell.
Yeah. And that's, I mean, considering the nature of how large this trade is and how entangled it was and the knock-on effects it could have on broader markets, it does make like, because that's another sort of narrative that's been floated out there, and it's like seems to be confirmed by the administration, is that you have the our economy isn't let them eat flat screens. Scott Bessent and Trump saying what's good for the Mag 7 isn't necessarily good for MAGA Americans, and like, is there a sense within the administration that they don't care about these hedge funds blowing up on this trade?
Yeah, but here's the thing though. We're so financialized, like I was saying, as a country, as an economy. If the stock market blows up, I mean, really blows up, we are headed for a deep recession. And the only way we can pull out of that is by printing more money. So what happens to bond yields? You know, bond yields will go up in that scenario because the bond traders, the vigilantes, are going to want to be compensated for the clear and obvious inflation that's going to come from another expansion of the money supply. And so that's the issue here. So do bond yields go down to 2% because we just slowly grind into a recession here? Or do they spike up to 5-6% because we have blown up the economy and the Fed's turning around and printing money to oblivion to save it? It's a good question. And that's why you're seeing a lot of uncertainty in the market. People don't know where we are on that spectrum. And some of it has to do with, you know, headlines and a tweet, you know, from Trump. I mean, he could just tweet something that just spooks the market to the point where, you know, you have the NASDAQ sell off 3 or 4%. Oh, well, look at that. It's down 2.5% today. You know, it was down over 3% earlier, I believe. But here's the telling thing. The telling thing is that bonds are not acting like they should as a flight to safety. That's number one. And number two, gold is absolutely ripping higher, rocketing higher, because it is a flight to safety. And investors are looking for a place to put money to just protect it. And gold has been a strong store of value for centuries. And now we get to the question about Bitcoin. And Bitcoin diverging today is very interesting. It's interesting because is it following gold? Is it finally, are people just realizing, like you said, that arbitrage, is that closing, that understanding arbitrage? Is it just because the dollar's so weak, which means that the dollar Bitcoin price goes up? That's part of it. You know, we were talking this morning on a different show, on the Macro Monday show, and Dave Weisberg brought up a great point that over the weekend, Charles Schwab talked about having a platform to trade crypto. And, you know, I've been talking about this for a number of months now that SAB 121, the full repeal of that through issuing SAB 122, for those who do not know what I'm talking about, this is where the Fed a couple years ago did an end zone run around legislation.
The U.S. financial system is caught in a trade it can't unwind without triggering collapse. Once considered the ultimate safe haven, the bond market has turned toxic, with yields spiking as investors brace for more money printing, rising inflation, and hidden economic damage. Despite growing pressure, there's no smooth or safe way out. Hedge funds may shift pieces around the edges, but the core issue remains. Unwinding these positions without direct Federal Reserve intervention could be catastrophic. According to James Lavish, this is the dangerous reality of a hyper-financialized economy, where the stock market now acts as the heartbeat of national stability. A sharp market downturn could send the U.S. into recession almost instantly. And when that happens, Washington has only one lever it reliably pulls: print more money, debase the currency, and hope the debt engine keeps running, all while pretending there are no long-term consequences. The problem is, those once trusted, risk-free assets like treasuries no longer offer refuge. As bonds sit at the center of a fragile system, Bitcoin is showing relative strength, increasingly standing apart. If even one part of this delicate trade breaks, it could ripple through global markets, and Bitcoin may be one of the few assets outside the blast zone.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.